What's up, guys? I hope you are well. I hope you're having a great day, whatever you're up to. I just wanted to make a quick video to go over why we trade this way and really the difference between a retail trader and an institutional slash smart money slash footprint slash professional trader. And in the last video, you would have seen this image. So this really is just about going a little bit deeper into what this image represents and why we're going to trade the way we're going to trade. Now, essentially, the big circle is liquidity, which is money. And if you don't understand liquidity, that's going to be the next lesson, so don't panic. But essentially, think of liquidity as money. Now, about $5 to $6 trillion per day is injected through the Forex markets alone. So with that being said, you think of how much money that actually is, and that is what the big circle here is represented. Now, there's another big circle within the circle called retail traders, speculative money, which is them throwing money into the markets, which occurs of them putting stop losses in, of them putting orders in, pending orders, instant orders, spread orders, bet orders, whatever. Okay, they are placing orders based on patterns that they rely on to keep themselves consistent in the market. And then there comes the smart money. Now, obviously, everyone puts liquidity into the market because that's how you invest into the market. You set an order, you put your money into the marketplace. But the reason ours is such a smaller portion is because not as many people are doing it. And ours is more of a sensible approach to the marketplace in order to actually extract consistent profits. And we work in the completely opposite way to what retail traders actually do. But we don't work in an opposite way to what the banks and institutions do. What we actually try to do is ride the coattails of these guys, of the banks, the institutions. And the retail traders work against the banks. And the banks, the institutions, the high players of this game, they know that. And they use manipulation in the markets, which is what targets retail traders. It targets retail traders because the patterns they use, you're going to start seeing and you're going to start noticing its liquidity. So this is just a lesson to really kind of illustrate that and kind of explain to you why that is. Now, we know that the banks control the markets. We know that the retail traders don't control the markets, and neither do we. But what we do is copy what the banks do. We know how they try and trade. We know the orders they put in. And we look for liquidity grabs, liquidity pools within expansions and retracements, which was explained on the last video. And that's our entry model. And that is the same way the banks move. Now, they've done this for 100 years. And the more and more people we introduce to this way of trading isn't going to affect the way they do it. They have to do it in order to make money. And it's going to take generations and generations of people to join into this strategy before we even come close to the number of people that are doing it from the retail end. And what the retail traders are doing, they are putting speculative money into the markets. They're guessing. They don't know anything about price action necessarily. They don't understand why they get stopped out, when they get stopped out, and they typically go for less reward when it comes to risk reward. So they might risk 1 to 2, 1 to 1. And so we like looking for a 1 to 3 as a minimum, but ideally we're a 1 to 5 risk, a 1 to 10 risk, and that's how we do it. And that comes via searching for accumulation and distribution. And we're going to explain all of this, so just don't worry. This module is about explaining the fundamentals. So without further ado, let's just go on to something else which I've created. Well, not created, I've found on here. So this here is the foreign exchange market. Literally searched in on Google, and essentially this just explains what it is. Okay, explains what the foreign exchange market is, explains the history, explains the size of it. It really is, a really healthy looking tool just to explain the history behind it and where it is now. Now, in terms of market size and liquidity, you can see here that obviously it's been increasing from 2007 onwards. I mean, if we did that now, that would obviously be up here somewhere just for the sheer amount of volume and money that's played around in the markets now. But the key thing I want you to focus on is the market participants. Now, bear in mind what I said earlier, about $6 trillion is injected and pushed around the markets, just in the Forex markets, every single day. Now, the top 10 currency traders that share the value of the market to what they're trading is predominantly institutions and banks. So you can see here, number one, 10.78% of that value, the $6 trillion, is injected through the markets every single day, and that is JP Morgan. Okay, that is an extraordinary amount. They cover 10% of the markets. UBS, 8.13%. XTX Markets, 7.58%. The Deutsche Bank, 7.38%. You know, it just goes on and on and on. And what we can see here is when you add all of that up, that's an extraordinary large population of institutions and banks that are actually trading. And the list would go on, you know, if you go on to sort of top 20, it would be more banks, more institutions. You will never find any of us on this list. We are well and truly the little guys. Okay, but what we look to do within this is we try to trade the way they trade. And that's why we are doing it. And this is about what we're going to really learn in this whole course. And you know, they trade in a different way to us in terms of how they place their orders, how much volume they put in orders, but they do it at points where we can identify key areas. Okay, when price expands to the upside, it means that, you know, JP Morgan are buying a lot of volume in the markets, but what they've also done is left sell orders lower down. So they need to come back down to mitigate against those orders to collect that money. And it really is as simple as that. So that just puts it into volume. And if you want to search it for yourself, please feel free to. It's just all you have to do is type in the foreign exchange market on Google, come up with it on Wikipedia, and you can just come down to the market participants section here. Now, when we go on to sort of Forex patterns, I've literally just typed in Forex chart patterns on Google. And what you can see here is all these different types of strategies that people use. Now, we can see we've got this head and shoulders pattern. We can see that there's the opposite, the inverse head and shoulders pattern, a double top, a double bottom, a triple top, a triple bottom, a falling wedge, which is pretty much a trend, a diamond, all of these different type of things here, consolidation, a flag, you know, a cup and handle, a rising wedge, a rectangle, which is basically the same as that. It's just worded different. So there's a serious amount of patterns here. And as a smart money / institutional trader, all I see within here is liquidity. And all the banks see here is liquidity. So this consolidation phase here, we know as the smart money traders that price is going to take both of these out. So that there is a bad strategy for a retail trader. These double tops, that's liquidity. The double bottoms, that's liquidity. People are setting orders to place within here to make it a triple top like that, and then hope that price takes it down. But it doesn't always work that way. You know, this here is a trend, and everyone says the trend is not your friend, and it really isn't. The trend is your friend, sorry, but it is not your friend, because essentially price moves lower to take that liquidity out. But again, like I said, guys, liquidity is going to be the base of the next lesson. So just to kind of show you some examples, I mean, look here, that there's one right here now. You've got this trend line coming down, and liquidity has been taken. This pushed up to the upside down here. You know, I wouldn't mind betting that the next thing, you know, we can see this liquidity that's being injected in here now, and you know, I would not mind betting to see this price actually coming lower from the point of base of where it is right now. And actually, the reason we're probably coming down is because we're taking this liquidity here in the form of this trend line. You know, when you go on to other time frames, if I just delete all of this here, and you know, you can literally see here, what's this? That's a double bottom. You know, we can see here this double bottom right here. That there is liquidity. What happens? Price comes lower and then moves higher. The amount of people that would have expected a triple bottom there is just amazing. You can see it right here as well. This liquidity has been formed with this double top here, and liquidity, smart money, institutions has taken that price out and gone in the direction that these people thought they were going to go in anyway. You know, exactly the same thing happening there. There's another double top right there. and we can see price took it out. You know, you can really do this all day and just really scour through the time frames to just watch for it, see the traps. You know, you can see this kind of wedgie type of action here. It's relative equal lows. You know, 1, 2, price is taken. It's giving you a little bit of hope with this triple top here, because you know it had a slight rejection to the upside, but then essentially price pushed lower. You know, we can see the form of here, this little trend line that was formed right here. Price comes higher. We can see this trend line here being formed. Price moves lower. You know, so if you are a retail trader, I mean this in the nicest possible way, but you have to unlearn a lot of stuff. And I had to do it because I was a retail trader. You know, I can tell you now, part of my strategy when I was first getting going with trading, when I was first taught trading, was to basically look for the cycle, because I was taught the trend is my friend, and I would wait for 2 full cycles, 1 cycle, 2 cycles. And then I had to get into the next cycle. I was always taught to get in on the 3rd cycle, and I could never understand why price never got me into profit, because all that happened was that. But now I see it from a liquidity perspective, that price was taking the trend that it created. So the trend is not your friend, and that happens all the time, guys. So hopefully this has kind of explained why we're looking to trade this way. And as some homework, because we haven't really done, you know, we've hopefully you've been filling in all your SWOT analysis and all that kind of thing there, but in terms of homework, we haven't really given out anything out on such as the charts. So all I want you to do is pick 5 pairs at random. They can be any 5 pairs you want, and you can go on any time frame you want. I would say anything from the 1 hour above, just so to prove that you're kind of looking. And I want you to essentially search for anything you see within here. So if you can identify head and shoulders, identify and see that it's not working. If you can see a triple top, that there is liquidity. See price pushing higher. If you can identify consolidation and see price moving outside of it, you know, really expose the retail world for what it actually is, and just move around the charts. It shouldn't take you too long at all. You know, you can see here we've got liquidity right here in the form of these, you know, relative equal lows. That there's a little trend line. Price has taken it out. You know, equal lows down here. Price has taken it out right there. Equal lows. Price has taken it out. That there's a 1, 2 coming into a triple top. People are going to buy. They've been taken out. So I just want you to identify areas that you see, and they don't have to be perfect. They can be relative. 1, 2, 3. This is like your head and shoulders pattern, is it not? You know, look at this here. So I can just about notice the shoulder, the head, the shoulder. So people now expect price to come lower, but actually what's happened is it's disrespected that area completely. You know, that there is a retail chart. The institutions know that. We had that heavy expansion to the upside. You know, and then price was tricking us even more because it created a double bottom. So a lot of retail traders would have thought to themselves, actually, I can now see a double bottom, and even then a triple bottom, because, and it's given us a rejection here. This would have enticed so many people to come into the markets, and then price dumped, you know. And then again, we had this double bottom here and turning into a triple bottom. Price moves even lower, and then it moves higher again. Just go around and identify these areas, guys. They are everywhere, and you'll kind of get a better feel for what the banks are actually up to and why they're doing what they're doing. So with that, guys, I'll leave it with you. 5 pairs, have a look, see what you can do. Find the retail patterns, find the price moving in the opposite direction, i.e. exposing the retail patterns. And with that, I will see you on the next lesson.